We had that subprime fiasco back in 2008, this fierce bottom in the metals and mining sector. And then we started to see a massive return of capital back into the space come the end of 2009, 2010. We're now in this 2022, we're approaching or at that exact same bottom. Yes, things may go lower for sure. Some investments may falter and maybe not even come back. This is sort of the risk that you take with speculative stocks. But the returns, as we saw in that image in 2008 to 2009, is not only 100%, we're talking 10 baggers, 20 baggers.
Today's guest is a supporting sponsor of Liberty and Finance.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Tony Reda, the President and CEO of Tectonic Metals. Tony, thank you so much for joining us today.
Thank you for having me again, Elijah.
Well, it's great to have you, and it's very interesting what we're seeing in the gold market. We interviewed you right before the Rural Symposium. It seemed to be like the bottom of the market, and when we met at the Rural Symposium, it's crazy because it's like there's all these fantastic opportunities here in the sector because of the low gold price, the low silver price. It seemed like what we were seeing was 2008 all over again, as you mentioned, where it's just everyone is throwing in the towel, everyone is selling regardless of value out there. So I wanted to get your perspective on where we are right now as we have continued to see prices fall. Where are we right now, and how does this compare also to what we have seen in the past?
Yes, thank you for that. Well, where we're at right now is essentially same thing, same as before. These markets and sort of the pain and suffering is sometimes not as quick and sharp. It's more of a death by 1,000 cuts, let's just say. So, my statement that I felt that it was 2008 all over again was predicated on what I experienced in 2008. And funnily enough, I actually found a slide that supports that thesis or that belief. So I'm not alone, and maybe some of your listeners are not alone either as I show that slide here. So this is something I pulled from Crescat Capital, and we're looking at the S&P 500 metals and mining index, and you can see, this big sharp bump. If you recall, 2000 was also a recessionary period. So we saw this huge bump here in the S&P, and again, this is metals and mining, a drop, and then 2000 to 2009, we had that subprime fiasco, the asset-backed paper, the mortgage fiasco, whatever you want to call it, back in 2008, this fierce bottom in the metals and mining sector. And that was exuberant, quick, irrational selling, throw the baby out with the bathwater. And then we started to see a massive return of capital back into the space come, the end of 2009, 2010. And oddly enough, as I said earlier, we're now in this, 2022, and we're approaching or at that exact same bottom. So where do we go from here? Is it going to continue to decline? Is it going to go up? I don't necessarily know. I have a feeling. And, when someone asks me, as they did at the Rural Symposium, is this the bottom? And my response is, I know it's not the top. So, Bitcoin at $70,000, that feels like the top to me. Gold right now, or metals and mining exploration companies or mining equities, this sure as hell feels like the bottom. So whether it's next month, 6 months from now, I think, now is definitely a time to look at value investing and look at opportunities. We all want to buy low and sell high. Well, that's easier said than done. It takes courage. It takes fortitude to step up and actually buy something when everyone else is singing the blues.
I think this chart that you're sharing right now is so interesting because, you see right after that bottom, it just shot up higher multiple times compared to the S&P. And I think when people are looking for value, that's the important thing to look at, is the ratio of certain assets compared to other assets. Because at the end of the day, the dollar value, that's just a number. It matters how much you can purchase other assets for with particular assets that you're investing in. So I think that's just so interesting how fast we see that run up after the 2008 bottom.
Yeah, most definitely. So we're talking about a shift back to value investing. So I think the euphoria, whether it was my son, age 13, deciding to buy Bitcoin, his first ever stock, those opportunities, Tesla, Amazon, Apple, Bitcoin, those were growth opportunities or growth investing, I would say. And that's kind of where the majority of investors went. I have this saying that money follows money. So wherever money's being made, that's where people tend to invest. The true contrarian investors are few and far between. Right now, I would say investing in mining equities or possibly in gold is a bit of a contrarian mindset. Maybe not so much gold bullion or physical gold, that seems to be catching on a bit more, but investing in actual mining equities is a bit of a contrarian approach. And, Benjamin Graham, who, is someone that I definitely value, he's, the father of value investing. He brought this premise forward and is commonly referred to as the mentor for Warren Buffett. He says successful investing is about managing risk, not avoiding it. And I like also the other quote of his to the right of that image, which says, to be an investor, you must be a believer in a better tomorrow. And the bottom quote is something I live by and adhere to. Probably need to revisit it more and do it more, but every day do something foolish, do something creative and something generous. And what I really want to highlight that we have to return back to fundamentals and value investing to drive our investment decisions. We have to exercise a bit of discipline and not jump into perhaps these growth opportunities or these opportunities where you're catching a falling knife. The valuations, for example, for some of these growth opportunities don't justify the fundamentals or the earnings behind them. So looking for value, is something that I think is definitely something that it needs to be done more and get back to, reading financial statements and things of that nature and doing your homework. So I think the mining space definitely presents value right now. And I do have a few other slides that supports that belief.
Definitely. If we can look at those here. And also, it seems like if we do look at the values right now, they're incredibly undervalued. That doesn't mean they can't go lower. But if we're going based on fundamentals and we're trying to be contrarians here, it doesn't really matter if we're looking for the long term, if we're following a trend.
Most definitely. You're never going to buy at the low. You're never going to sell at the high. I think, you have to obviously lace up the skates, if I can use that analogy, and get on the ice in order to score. If we're using the hockey analogy, or in football, for example, you have to get on the field. Right now is a great opportunity to get on the field. And yes, things may go lower for sure. Some investments may falter and maybe not even come back. This is sort of the risk that you take with speculative stocks. But the returns, as we saw in that image in 2008 to 2009, is not only 100%. We're talking 10 baggers, 20 baggers. I had a few investments that I made in 2008, late 2008, took advantage of some tax loss selling that was transpiring, further driving these stocks into the ground more, and they catapulted at the end of 2009 with remarkable gains. Those opportunities don't come around every day. So the recession does bring opportunities for those that can withstand the pain and endure the discomfort and then make some magnificent gains. I prefer those types of opportunities versus, trying to buy in a bull market where the stock keeps running away from you and you're chasing something that doesn't match the fundamentals.
Definitely. If we can get more into those fundamentals, if you had a few more slides, I believe, on gold's performance in the mining sector in recessions. Okay.
So this is something that I snagged from the Elements website, elementsvisualcapitalist.com. So I'll give them props and kudos for creating this graphic. The data is from Macro Trends, and this is from 2022. So what you're seeing here highlighted in yellow is gold's performance in relationship or in comparison to the blue line, which is, again, the S&P 500 index. This is not a metals and mining index. This is the general S&P 500 index. And what you can see here in the first recession noted on this chart, which was just 1972, 73, let's just say, oh, there it is, 1973, gold's performance plus 87%. That's the gold price. And in relation to the S&P 500, negative 13.1%. 1980, gold down 5%, S&P up 8.6. Then if you look at another recession down here, 1990, 0.1 versus plus 5.4. And then you start to see gold 5% here in 2001 versus the S&P down 1.8. Here's another big gap. Gold up plus 18%, S&P 500 down 37%. And here, fast forwarding to 2020, 22, you can see gold down 2%, but the S&P down 18%. I envision that spread to get larger here. And what this is telling us, or at least to me, is that, not every recession is the same. There can be some variability, but generally speaking, gold tends to fare better. And the other thing to know, people want to see this big green plus X% in gold price performance in relationship to the current recession. What we have to keep in mind is that, gold is a safe haven. And even if it just maintains, it's going to fight the pressure of selling much better than other assets or other equities, in my opinion. So gold is definitely a place where you can sleep better at night, knowing that your investment is safe and will endure the test of time.
And then your perspective on this, because how do mining stocks and also exploration companies, for example, Tectonic Metals, then give a leverage play on the gold price?
A backdrop of a high gold price just benefits benefits everyone, let's just say, everyone involved in the mining space. So the gold producers that are producing gold, a higher gold price obviously creates more profit and more revenue and better earnings. So that empowers them with more capital. Then they start to look abroad more aggressively at M&A opportunities because their share prices have gone up. They now have a currency, i.e. their share price, that they can deploy and start buying assets. And also they can deploy their capital in buying assets. So it creates a very positive environment from a corporate sort of acquisition M&A perspective. It also, again, draws people or investors, the generalists, also into the space, and they start at the top and they start looking down at the bottom. And so, yes, I'll buy Barrick and Newmont, but, what other great discovery is something that may be palatable for a major mining company to go and acquire. It also brings junior speculative investors into the space and say, you know what, I can buy gold, and yes, that's a great thing, but I can also buy gold equities from the bottom right to the top. So this is why although as an exploration company, we're not producing gold, but inherently better gold price does improve the environment and the climate from an exploration perspective.
And then could you expand on the need for exploration right now, as we're probably going to see a higher demand for gold, and how does a higher gold price impact exploration companies like Tectonic Metals?
So a higher gold price, as I mentioned earlier, just creates a fantastic backdrop or environment conducive to more capital going into the space from investors, but also major mining companies starting to look further down the food chain for where they can replace those ounces. So every day a major mining company is in production, they're depleting the reserves, and gold is $1,700 or $1,800 US an ounce for a reason. It's becoming extremely difficult to replace those ounces. So I personally believe that going back to organic growth, so grassroots discovery, there's a renaissance that's going to unfold there, where the investors, the major mining companies are going to say, okay, we have to go find these things from the ground up. And exploration budgets, and I'll share a slide to reflect that. So here we have gold price versus exploration budget. So the budgets are highlighted in blue. And what you can see is that gold has significantly gone higher, but yet budgets have gone down. And that's, probably a function of investors focusing capitals on, balance sheets of the major mining companies, and the move again into growth-oriented stocks, not so much exploration companies. And what you can also see here on the chart on the right is the relationship between the gold price, the gold discoveries here. What you'll see here on the right is gold discovery. So we're looking at greater than 2 million ounces. And this is the highlighted in yellow here. And then in blue is the time frame of those discoveries. And so we had a huge peak in gold discoveries in 1990, but that has dwindled significantly to historic lows, let's just say, especially in relationship to the amount of ounces being discovered here. What that tells me is that, we need to explore and find ounces. Buying existing assets, they're few and far between. A lot of those have been gobbled up already. And if we look at the major mining companies, the top 10, you can see here, for example, Newmont. I mean, they're producing, almost 6 million ounces of gold per annum. This is 2021 gold production in blue, and in orange here, 2020 gold production. And, Barrick even, just 4.7 million ounces. So where is the next 4 or 5 million ounces? All these major going to come from where all these major mining companies here need to replace the ounces. And I think there's definitely going to be a movement back to grassroots exploration that is going to, fuel sort of the next renaissance here.
And when it comes to exploration companies, one of the things is that, it's very actually difficult to find one that will succeed. And because at the end of the day, about 99% of exploration companies do fail. So your perspective on that, how people can pick the right ones. And also, I remember you were talking at the Rule Symposium about this, that very few exploration companies actually have a solid business model, but Tectonic Metals actually does. So can you explain for our viewers, how do they look at the fundamentals of the company to make sure, this has a good chance of succeeding? And then also, how does the business model play into that for Tectonic?
Yes, I recall you being at the Real Symposium, and I did present a workshop entitled Evaluating Mineral Exploration Companies, and I'd love it, perhaps one day down the future, to present that to your viewers. But in short, how do you evaluate a mineral exploration company? You can walk around a conference floor, and how do you assess? It's a very technical, science-driven industry, and sometimes the language us issuers or us companies are speaking is a foreign language to many people. So what I came up with is essentially 4 pillars that you can see here on the slide that you can utilize to evaluate companies and their merits. And the projects pillar is going to be a bit more, lean more towards science. So I encourage people to use your inherent natural skills, and maybe some people are more analytically driven. So, that's where the financials start with that pillar. If you're more of a people person and you have a good judge of character, start with the people, start with the team. And the benefit you have with the mining or the exploration space is that you can reach out to CEOs like myself and meet the people behind the company. If you want to bet on a company making a discovery, go meet the vice president of exploration, or maybe it's the CEO who's also a geologist. Just hear what their thoughts are on the project or how they endeavor to do that. So I try to encourage people, don't get engulfed in the entire 4 pillars. Start with the first filter. And if the company passes the filter test, then go to the next pillar. But start with the one that works for you. And it goes without saying, regardless of what industry you're in, it's the people. The people make the difference. From Apple to Tectonic to Barrick, the people make the difference. And in our case, we've tried to build a team that not only is passionate about mineral exploration, but also we look at all the different aspects of what makes a good company. And it's not just geologists. This is a business. I think people, and when I say people, more specifically to us companies, we forget as publicly traded companies that this isn't a science experience. This is not a geological exercise. We need environmental people. We need capital markets people. we need marketing people. These are all important aspects of what makes a great team. And then we talked about the business model. Well, that's where the strategy comes into play. To me, it's shocking if someone has a business background. When I first started investing in mineral exploration companies at the age of 21, I was asking people what their business model was. And a lot of companies don't have one. And it's like, okay, how do you run a company without a business model? So at Tectonic, for example, we'll talk a bit about the business model. The business model governs us, grounds us, and provides us a plan on how to move forward. Next up is the projects. What is the merit of the projects? You can evaluate those on various levels. And again, I'll save that for more of a fulsome conversation. But there are key things to ask about the project. And maybe I'll just share one quick slide here that provides a bit of a synopsis on the various pillars. But, what is the geological potential? Is this company, is the team, does it match the merits of the project? For example, if it's a grassroots exploration project, does the team have explorationists? If the project is more resource stage and moving into feasibility or PEA, the PEA is a preliminary economic assessment. The feasibility study or a feasibility study is the most rigorous engineering and financial study that is done prior to making a decision to move the project forward into construction, development, and then production. So if the projects at that stage, the team needs to have engineers and financial people that can really raise significant amounts of capital to move that project forward. Location, jurisdiction, those are the things that we need to look at from a project perspective that can really impact the project moving forward. Then we have the corporate share structure, and should be if you're investing, this is the crux of it all. Does the company's balance sheet reflect the objectives that they're trying to do for the next 12 months? Does the team have the ability to raise capital in a bear market? And obviously they can do it in a bull market, but can they do it in a bear market? And what is monthly burn rate to keep the lights on, and how much cash do they have to move that forward? I will touch upon maybe the Tectonic business model a bit here to share exactly what we do. So as I mentioned, we're an exploration company, and our team reflects all aspects of that sort of the exploration stage, but also we have experience in feasibility, construction, and production as well. But the true sweet spot of our team is centered where our projects are positioned. And what you're looking at here, this chart, is the life cycle of a junior mining company. So these are the various stages that a project will move through. Essentially, exploration, discovery, feasibility, then you have construction and production. And what's shown here on the left here is the share price performance. So this is conceptual, but we talked about that deficit of the need for the major mining companies to replace ounces. Well, not only do the major mining companies acknowledge that, but also investors. So when you make a bona fide discovery, the share price can really catapult quite quickly and generate some significant returns. And then as you move, once it's known, for example, what the resource is or what the economics start to look like in the feasibility stage here, that's where you start to get perhaps, the share price starts to stabilize. It might come off a bit and carry forward, because that construction to production period, as shown there with the time on the x-axis there, it can actually be, discovery to production can sometimes be 15 to 20 years. I think, so that's a long drawn out period. And not all the investors want to endure that time frame. This is also when the shareholder base shifts from initially in the earlier stages from a retail audience or shareholder base to more of a fund institutional share base. Why do we focus on the discovery stage? Well, as I said, quick, significant returns. If a discovery is made, they typically have a lower acquisition cost to generate these projects or acquire them. Our projects have to have a linear path forward. And what that means is with every acquisition that we make, I already know what I need to do in the first 3 years, how much capital it's going to take, and how much time and what actual geological or exploration exercise do we need to do to unlock that. So I like a linear path. because conceptual targets, things of that nature, can be quite difficult, hair pulling, and they don't always come to fruition. The other key aspect of our business model is managing risk. And this is really the forefront of the entire business model and how we operate. And the reason being is that most projects, as you said earlier, 99% of them fail. So wouldn't it make sense to try to manage the risk from the get-go, from the very beginning, and focus a lot of your time and energy on that aspect? So how we manage risk, it is on the project side, but it's on the whole company side as well. But more specifically to the project, we start by working in a jurisdiction that we believe is pro-mining, where we know where the goalposts are on day one. They're not going to move or change, on year 5 or year 10. We operate in Alaska. We speak the same language. It's safe. It has a predictable permitting process and timeline. We also elect work directly on native-owned land. And that's something different than what most companies do. So we approach Alaska Native corporations and ask them, do they want to work with us? Do they value mining as a sort of a path forward for them in creating value for them and their shareholders? And the Native corporation that we've partnered up with, they're actually the largest landholder in the state of Alaska. So they're blessed with a lot of opportunity. We have a direct conduit into that. Indigenous or ESG risk or native risk is huge. So why would you want to explore in an area where you're not welcomed? And that is a common theme in our space. We've taken this relationship with our native partner one step further and actually invited them to be shareholders in our company. So they actually made not one, but 3 significant investments into our company. And they have deployed their own capital in saying, okay, we recognize the need for exploration or for finding commodities, gold, things of that nature. And we want to support Tectonic in their efforts. So this is all part of our ability to manage risk. And regarding the projects themselves, we want to always maintain optionality. So we're not so rigid and so proud that we have to advance this project ourselves. You have to shift. And whether it's COVID or recession, what it's taught me is one key word, and that's adaptability. You have to adapt as a company to the current environment you're in, whether it's capital raising, executing an exploration program, or where you choose to operate. You have to keep it adapting, and having optionality at your fingertips is extremely important in these times. Does that help explain a bit more about the business model and kind of what we're up to?
I think it does. And I think one of the key things, as we mentioned, that, exploration companies do have higher risk, but there's also the bigger reward, as you mentioned there. And I think the fact that you're, consciously managing the risk is, I think, so important, because I remember Rick Rule talking about at the symposium that he has been involved in a lot of mining companies or exploration companies, and it's actually a big percentage that have succeeded that he's been involved in. So if you have that ability to look at a mining company, as Rick Rule has, and as he invited you to the symposium, I think that says a lot just by having that endorsement from Rick Rule, by having you at the symposium there. It really reduces that risk, but the reward potential is still there at being an exploration company.
Yeah, and I'm glad you mentioned that, because that's actually, going back to one of the pillars. We talked about the team or the structure there, and looking at the shareholder base of a company can definitely, they've done a lot of the heavy lifting for you when it comes to due diligence, providing that you have respect or believe in the shareholders. For example, Crescat's one of our largest, actually is our largest shareholder, and they're advised by a geologist named Quentin Henning. If you respect Crescat and with how they manage their funds, and they have one of the best performing funds right now in the space, they've done their due diligence. If you have a native corporation as a shareholder, well, guess what? They've done some of your due diligence as well. If you have Rick Rule as a shareholder, well, maybe there's some some merit to that as well. And that tells you, okay, well, if Rick's going to invest, maybe I should look at this. So I always encourage people to ask who the shareholders are. And not only is it important to have sophisticated and respected funds or native corporations on your shareholder registry, it's also important to have the people of the company on that registry. And you'll be surprised just how many management teams or executives teams don't own a whole lot of the stock. And then the follow-up question to that is, what did you pay for your stock? So, you could have a big insider ownership, but did you get all those shares at a penny, or did you get them all for free? What did you pay? Are they supporting the current market? And I will say, as a CEO and also a father, we don't, myself personally, it's not like I got millions and millions. I can keep buying the stock nonstop, but I am the single largest shareholder of this company. And right behind me is my two other directors. And then we have the funds supporting this company as well. So I think that's definitely an important due diligence exercise. And it was an honor to be at the Rick Rule Symposium. And, he handpicks every exhibitor there. So obviously he sees something of merit and thought that, others should get exposure to that.
And before we let you go, Tony, we had some viewers submit some questions. William is wanting to know, how will mining and tectonic metals in particular be impacted by ESG regulations? Okay,
so I think we need to start by defining ESG, environmental, social, and governance. And ESG is very much a hot topic right now, and rightfully so. So we were doing ESG before it was called ESG. For us, it's just the right way to do business. So ESG, whether it's on becoming a criteria, for example, companies like, or funds like BlackRock, and these are investment funds, they need an ESG box ticked. They want to see ESG reporting. So, and that's not going away. So that if you don't meet the criteria on that front, you might not get capital. Some investors are now, and again, rightfully so, that they need to see that component ticked. On the environmental side, are you acquiring projects or working in protected parks? Things of that, or near a protected park. Well, you know what? You're swimming upstream from day one. And the geological opportunity doesn't trump everything. And our industry has a past of letting the geological opportunity, trump everything. And so, we'll try to figure out how to make it work. Well, yeah, sometimes it does, sometimes it doesn't, but just be aware of those risks. So ESG impacts us tremendously. And we take that very seriously. So we do our due diligence before acquiring a project. And when I say due diligence, it is an environmental audit. It is going to meet or visit the local communities and villages and getting their sense of whether or not they want you there. For us, we work directly on native owned land. It doesn't get, I would say much better than that, especially when, from an engagement perspective. So we're getting not only shareholder alignment on day one, we're getting stakeholder alignment on day one as well. And so on the governance side, we also have core values that govern how we operate, and every Tectonic team member has to meet or has to embody those core values. So from our perspective, we think we're doing, is there room for improvement? Hell yeah. But we think we're definitely a leader in that space. And to also further emphasize that, our lease agreements, our project agreements, so I said we work directly on native land, we've actually mandated in these lease agreements that they cover not only exploration, but full-scale production. So these projects are positioned at the discovery stage, but we have a production agreement that we can run with into production. That is created by design with intent from us and our native partner on day one. What we've also done is we've mandated preferential hiring for the local communities, local villages. We have communication protocols. We have environmental audits. Again, these are mandated in a legally binding agreement. We have scholarship contributions to nonprofit organizations. This is mandated. This is a must. So I can hold my head up high knowing that when I go explore property, I've done what I can to the best of my ability to know that, I'm there and everyone knows I'm there. and they are supportive. Now, this doesn't encompass everything. It's not going to be a slam dunk, but it's definitely much better than, say, a traditional approach where you don't engage till year 5 or year 3 or till you have something. Then you say, hi, I'm so and so. This is what we're doing, and then they're like, okay, well, this doesn't work for us. So, that's a bit about our ESG philosophy. I will add one other thing, because I'm passionate about this topic. I can even talk further. Our chair of our company is an environmental biologist. She's also been involved in the permitting of 9 mines in Northern Canada. She's worked for major mining companies. She's worked for companies such as ours. She's represented and worked for directly with Native or Indigenous groups or villages, represented them. She's worked for the government as well. So I don't know right now off the top of my head how that many or any board of directors in the junior mining space that have an environmental biologist on their board.
Fantastic. Well, Tony, we really appreciate your time today. Before we let you go, all our viewers should check out tectonicmetals.com. Any last thoughts before we let you go? And can you remind our viewers, how they can get in contact with you?
Most definitely. So I love engaging with people, and more specifically, people interested in tectonic. So please do reach out to myself or our investor relations for our company. Our email address is info@tectonicmetals.com. You can address it to Tony Reda and I will see it. You can also follow us on social media. We're on LinkedIn, on Facebook. We also have a website, tectonicmetals.com, where you can sign up for company updates. So thank you again for your time. Please send in any questions or comments you may have, and I look forward to speaking to you again.
Sounds good. We'll definitely have you on again soon, Tony. Thank you so much for your time, and God bless.